Today we're going to talk about tops of markets. We're going to talk about strategies to hedge those, if that's okay. We're going to talk about what types of markets, what's a correction, what's a bear market, what's just a pullback. We're going to cover all those things if that's okay with you. Is that okay with everyone? Okay. So, firstly, I'd like to go through the definitions of the market. So firstly, we have a correction. That's basically where the market corrects or trends down for 10% or more, which is called a correction. Once the market pulls back more than 20%, we call that a stock market crash. Okay, so it's the definition of a crash. Everything else we just call a pullback. So anything less than 10%. So we need to read the top of the markets. For those who haven't seen, we're doing market wrap at the end, but we're right after the top of the markets. We're at all-time highs. At some point, historically, markets will turn down. I've heard many times that it might be different this time, and we'll look at the reasons that it might be different this time for a while longer. That's okay with you. So I believe that we need to be able to read markets and have a good turning points. I've been trained by some good hedge traders, and they've taught me some tools there which I'd like to share with you today. Okay. Everyone should have a handout. Remember a handout? Yeah. So we'll go through that. And basically, this is a tool. This is not a timing tool. This is important to remember. This is not a timing tool. This is a tool that actually looks under the bonnet of the market, right, to see what's happening and puts you on alert. Okay, so we'll go through the strategy because this could be a pullback strategy, it could be a stock market strategy, and then we'll talk about some of the strategies we could put in place if we identify this in the market. So I've handed out, I've given you a 10-point checklist. We're going to go through that 10-point checklist and basically how you need to implement it. Basically, when 7 out of 10 are pointing in the directions, there's 10 points on there. So we read 10 parts of the market, okay? I'll show you what hedge fund traders do. These are the elite guys in the markets, and this is what they're looking for, okay? So sometimes it's a self-fulfilling prophecy if they're all doing the same thing. So I may as well share with you what they're doing, okay, so that you're on the ball. So we're going to measure the market by using this 10-point checklist, right? But basically, if we get 7 out of 10, we need to be getting ready to implement some, one, or all of these strategies, unless you want to see your retirement blow up. We go through some of the corrections. The last one was 55%. I don't want to write through something like that, but I'll leave that to you to make that decision, okay? Now, what you remember here, we're going to look at some indicators that they've shared with me and I'm going to share with you that are actually quite complex and you don't need to understand. Trust me, they're quite complex. Sometimes you just need to, all we need to measure in the market with these tools, is it bullish, is it bearish, or is it neutral? Does that make sense? Don't overcomplicate this. I've said this time and time again, I have found I've been trading for over 20 years, and I just believe humans have a bias to make things complex. However, I've found everything I've been successful at, particularly with trading, is when I've brought it back down to simplicity. So trust me, just keep this simple. I notice I'm going to use any engineers in the room, put up your hand. Right, okay, so no questions, right? This is not black and white, this is all grey, shapes of grey.
It's in our DNA.
It is in your DNA, that's why I wanted to know in advance who the engineers were. I'm glad I've got nearly what? I've got a large percentage too. It's very interesting how engineers gravitate to trading. Anyway, we'll move right along. The other thing is, I'm happy to take questions, but I just don't want to get bogged down and stuff, okay? And then I'll just remind you of that. So traders battle emotions such as greed and trying to make the smallest amount in the smallest amount of time, right? And we've just spoke about that nauseam, or they have fear, which is the opposite side of the ledger, and that's an unpleasant anticipation of imminent danger, is what I call it. Most of these emotions are modest in relation to the market most of the time. However, sometimes these get extreme. And this is when the seasoned traders can make the most money, right? This is when knowing when to measure and take advantage of these extreme emotions provides the greatest opportunities. That's why we're going to go over those today, and then we'll actually look at the charts and we'll see where we're at. As I said, most of the money's made at these turning points. Turning points happen at extreme convictions, right? This is where people have convictions, and convictions aren't good as a trader, right? As traders, we try not to make convictions, because if we do, basically what I found, if you have a conviction, you'll find that psychologically all your bias will go and seek the information to confirm that you're right. So it's not good. Alright, so we try and have an open mind to everything. And even with the markets, we have an open mind. We look at what happens if it might go down and what happens if it keeps going up. Okay. So extreme readings are opportunities to take the contrarian side of the trade, right? As traders, we don't always do that. I talk about following the trend all the time. Except this is a point in time where we actually want to be a contrarian in the market, okay? Because this can be highly profitable if you have the discipline to continually measure the market, right? So if someone's convinced they're right intellectually, emotionally, or morally, it would be nearly impossible to change their minds, as I just discussed, because of human bias, right? However, Mr. Market doesn't care about people's conviction, will happily destroy your fancy. Okay? All right, so let's have a look at the first measurement on the sheet, which is the combined index equity put-call ratio. Okay? So 90% of the time these indicators will be in neutral. So the first few indicators are, as I said, quite complex. And these indicators, ladies and gentlemen, don't come up weekly or daily. You're lucky if you get one once a year, right? So they can be boring. That's what I say about the discipline about watching these. This doesn't take long to go through. It takes you a couple of minutes a day. And if you're a trader, you need to have routines, and I would highly recommend you make this part of your routine. So, because 90% of the time these indicators cause a lot of people to discard or dismiss them. All right? It's boring looking through something that never gives you a signal, isn't it? Trust me, it is. You're just going to make it part of your routine. A lot of this stuff, I'm going to show you where to find it. You can find it for free, right? So that's going to be a good kick, hasn't it? I'm going to try and see you something here. So I'll show you where to find some of this stuff for free, okay? So the first place we want to look is stockcharts.com, because I'm going to go there and we're going to get this information for free, okay? So you might want to put that down. So the stock code, once you go to stock charts, which I'll go in there later, and I can, when I get on the computer, we can go in there if you like. So we type in $CPC, okay? Stands for CBO put call, right? CPC. We change you go into there and there's two moving averages, which I'll show you, right? Now you delete the 200, you just go into the scroll bar and go up to none. And the 50 moving average, we want to change to a 10-day moving average, because that's what we're watching, the 10-day moving average. Okay, does that make sense? So we delete the 200, we change the 50 to the 10, and then it'll say, I forgot what the wording is, but reapply or press the button so it changes it. And then we want to see what that measurement is. And there we go. So that's what it looks like. Let's see if I can get this to work. Right. So we've just left one. That's the 10-day moving average. Oops. You you can see I've got 10-day moving average, and it's 0.87. That's actually taken on Friday. You might want to even fill in your sheets while you're there. Okay, so you get practice at this. Because I'm going to give you where the guides are. Down to 0.75, we're basically getting to that extreme level, and this is where it's getting closer. There's no one left to buy a stock, right? That's what happens, right? Basically. So we should start looking for the markets to roll over and looking at our stops or start taking out stops, right? At that point in time, I have strategies. Sometimes, like this month, there was points, like the market's been going up. Stocks only 25, 27, 30% in a few weeks. It's ridiculous, right? So generally I'm a trend trader and I wait for it to hit my stops, but I'm just not doing that at the moment, if that makes sense. It's like, or I take half off the table, right? Yeah, you can work out your own strategies on that basis. But certainly you want to be looking at your stops at this stage, if not some hedging strategy, but we'll talk about that as a whole. So that's the top of the market. The bottom of the market on a daily chart of 10-day super moving average, we want to be nearing 1 or above, okay? So they're the parameters. Because that's when there's too much fear in the market and everyone's hedged and short. And these are the opportunities that can make you a lot of money. At this point, then there's no one else to sell. So you need to be very aware when markets are bottoming, because we have a phenomenon called a short squeeze. Has everyone seen a short squeeze? You know what a short squeeze is? This can be absolutely brutal, and we'll take a look at Tesla. Has anyone seen Tesla chart the last couple of months? Now, that was the highest shorted stock a few months ago in the US markets, right? So let's go and have a look at a short squeeze, and I'll just show you what it'll do here. Right. Stand over here again. Convictions, right? Like that's like this. This is an example of a short squeeze of a bubble, which we'll talk about later, and also about having convictions, right? So it's a great chart, in my opinion. Okay, so neutral is a reading between basically 0.8 and 0.95. Okay, so if you're pushing below 8, you're nearing the top zone. We're getting to 0.75, and then vice versa. Once you're pushing to 95, you're getting up near the 1, right? So you should be watching that, right? That's the sort of stuff you'll be writing into your comments, okay? Okay, so let's have a look at the next measurement we're going to have a look at. That's the daily SPX index put ratio, right? Now, just a note before we move on from here, this one here is generally short-term in nature, and they're only good for moves for a few days, right? So it's a very short-term one. This is what hedge funds use basically for, most of them are swing traders, and they use this for short-term terms, okay? The other thing is, you're probably thinking, let me explain SPX. So SPX is basically S&P 500, which is the market, which is basically the market we follow, which is the biggest market in the world. People talk about the Dow Jones all the time. What are you talking about the Dow Jones? That's 30 big stocks, big deal. Okay? This is the market. This is the gorilla globally, right? Generally with sentiment, if this starts getting pounded, so it does every other market. Okay, so this is the market we watch, and that's why we use it. So it's got the SPX, so that's the S&P 500 on it, right? All right, so the previous moves can last for weeks. This one might only be for days, right? So let's make a note of that. So 2.75-ish is excessive put buying and looking for a bottom. And then vice versa, 1.75-ish. So everything in between, obviously, is neutral. Now, you might want to take a photo of that because all the rest of it you'll be able to get from stock charts. This one you'll have to go to a different website. So if you want to take a photo of that, or write that down. So if you type that into your search engine, that'll take you straight to the indicator that I want you to look at. 2.75-ish to 1.75-ish. It is 2.75 to 1.75. So if it goes a dot either way, they get to, you should be on the next day, if not several days. Have a note here, these are the best overbought and oversold indicators that I know of personally, right? Lots of you would know what RSI is. Does everyone know what RSI is? They're overbought and oversold, there's MACD, there's a whole lot of other ones. You compare that to these, there's just no comparison. Right? RSI can remain overbought and oversold in position for months on end. And I can show you myriads of examples of that, right? Go and have a look at stuff. If you start following these ones and you get good at it, as a whole, I think you're going to be surprised. Once again, you go to stock charts, and that's the ticket code for pricing. So they've all got dollar signs in front of them, and it's got a trim. It's pretty easy. Right, everyone got that? Okay, so the fourth measurement we're going to look at is the VIX. Does everyone know what the VIX is? It's also known as the fear index. They talk about the VIX a lot even on the news. So when people start to panic, they start buying puts at any price. This will move the VIX, right? So the VIX usually is down. It's down at about 15, I think, at the moment. Round back. You can have a look if you like. So basically, the higher the VIX, the higher the fear. However, at some point there'll be extremes, won't there? And that's what we're looking for, right? So I love the VIX for looking at extremes. Typically, these moments that create the greatest amounts of fear equates to a seasoned trader's best opportunities, right? And we get these here. So what we're looking for is a couple of standard deviations from the mean, and we use Bollinger Bands for this, right? I'll show you that. We'll have a look at that later. So fear in the market, basically, you know, I talk about the markets and the line in the sand is the 200-day simple moving average. Well, the line in the sand and the VIX here is generally 20. But for me, when I'm looking at markets charts, I can see fear coming in well before that. But anyway, if you talk to people about their line in the sand is 20, these things can spike up to 40 and up to 60 or even higher, okay? Not very often. So, as I said to you before, when we're engaging in either US or global markets, we use the S&P 500, which is the SPX. So in terms of that, we're looking for the price bars to come out of the top of the Bollinger Bands for extreme fear or to go bullish, right? To take that contrarian position is what we're looking for. There we go. Sorry, I didn't change that chart. As it says, using new technology, and I worked out how to copy the things I didn't do this one. So you can see we're looking for where the price action comes out of those Bollinger Bands. And you see wherever it doesn't come out of there for very long. Does that make sense? Right, so it doesn't come out of there very long, and they're our contrarian positions. Right, so that's what we're looking for. The next measurement we're going to look at is the skew. The skew measures the perceived risk of the move to the downside of 2 deviations or more. In layman's terms, this is what we call a market crash. Okay? And the skew is something you measure. This is where all the hedge funds are buying puts. And interestingly, they're starting to buy them now. I've noticed off the skew, where over a month ago, they were not interested in hedging at all, which is interesting to me. The value of the skew increases as perceived market risk increases. Historically, the range has been between 100 and 115 with an average value of 100 and 150 with an average value of 115. So, over 135 is bearish. This is perceived as high crash risk, okay? So that one is there, 134 at the moment. So we're pretty close. Because this one's looking, bearish in my opinion. We're very close, okay? So we're going to get through all of them, and there's not enough. There's a fair few bullish ones. So. I'll just carry on. Once again, this is also going to be found on the stock charts. And then, so the ticker code is dollar skew. Pretty easy. Okay? You all got that? Taking a photo. Alrighty, let's go. Okay, let's look at the sixth measurement. This is an easy one. Probably some of you already look at this today. So we just look at the daily price action of the S&P 500. Because price is the final arbitrator of markets, right? So the first price we need to look at is the main market, which I've told you I do. I look at this market, I come by the top-down approach, and this is the first market I look at. There's that, and then I go to the NASDAQ, of course, because that's all the technology, and that's the future, right? However, a lot of those tech stocks go into the S&P 500, or vice versa. So you can do this through any markets. You can do it through the S&P 500 or the SPY, which is the ETF of it, or the cash index, which is the SPX, which I said, or you can go to the ES mini futures. They all do the same thing, right? But I'm going to stick to, we're going to look at the SPX, okay? Because they're all measuring the same thing. We need to ask ourselves, is it trending up, down, or sideways, right? Pretty easy. I do this with moving averages as they are pleasing to the eye, okay? And so the moving averages I like are 8, 21, 34, 55, 89. Why, you ask? Does anyone know why I use those? No? Okay, I'll tell you. Because they follow the Fibonacci sequence, which is 1, 2, 3, 5, 8, 13, 21, 34, 35, 89, and so on. Can anyone work out the formula there? So 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, 8 plus 13 equals 21, 13 plus 21 equals 34, and so on. That's how the numbers. I want to do a Fibonacci presentation probably next time, and then I might convert it, right? They're just like magic. I find it very interesting even with charting. And then obviously I don't use all the Fibonacci's, I just use some of them. So what am I looking for? That the moving average is what I call stacked and in the direction that I'm trading. So if they're up, I'm on them going up, and if I'm down, I'm on them stacked down, right? So if I'm going long, I want the 8 EMA, which is the exponential moving average, not the simple moving average, right? Stacked on top of the 21 exponential moving average, stacked on top of the 34, stacked on top of 55, 89, and then stacked on top of the 200-day simple moving average. With that, depending on the stock and its characteristics, I like the price to be above the 21 EMA, which is generally what I call the mean. Somewhere between 21 and 34 is what I call the mean. However, ladies and gentlemen, we've talked about characteristics of stock before and how they're all individuals, right? Some stocks trade back to the 89 quite consistently, right? So then I'd use the 89, and that's why I like these moving averages, and I see where the stock sort of historically trades back to. And this is reversed for short or bearish trades. That makes all sense then. They're just stacked the other way. So the 8's on the bottom and 21 and vice versa. So daily charts are great for the immediate term, but they can give a poor picture for the big picture. Does everyone agree? We've talked about this before. Do you know I come in from a much bigger picture, could be from monthly, moving into weekly and then daily, and we do the same thing with this, with our strategy here, okay? So, there we have it, ladies and gentlemen. That's what I call, now, that is almost perfectly stacked. Would you agree? That's the S&P 500 at the moment. I mean, that's just, like, anyway, that's just picture perfect. That's like, you can see there, my yellow is my 8, magenta's 21, the pink's 34, and they're just perfectly stacked. So, if a chart's like that, can I go short? That's what I'm saying. So you think, oh, there's a market. Hang on, we just get trade wars, we've got currency collapses, we've got massive debt, we've got viruses, we've got, we talk about all this stuff and have fear. However, what's that say? They don't care about it. Sorry. All good. So, I couldn't, it's almost, wow. Whoops. So, I'm racing ahead. So, I mean, that's nearly perfect. Around there, perfect. Here we've had a little pullback, but the 8's still sitting above the 21, right? And I just think that's amazing with all the stuff that's going on, right? To me. Let's move on. All right, so the 7th measurement is the S&P again, but we're going to look at the weekly because we want to have a bigger picture. Now, what do we see there, ladies and gentlemen? With the stat. You know, it's the same thing, isn't it? That's a weekly chart. And the other thing is here is like, well, I don't use the 200 day there, but I mean, you get my point, is buying off this longer term chart. Okay, so the 8th measurement is the monthly price action of the S&P 500. Now have a look at that. That's on a monthly chart. So, if you didn't get in in 2009, why weren't you in at 2011? Anyway, that's just the whole time. It's going to the sky. So, if I look at these charts, what do I do as a trader? I've got to go long, haven't I? So I use some of these strategies because when we're in a market like this and we've got all this stuff going on, I want to hedge myself, right? So I can use these here, I can use turning points, and I can use, so I can still go long and I can still hedge myself, right? So I'm protected. It's called insurance. Everyone here insures their car and their house, don't they? What, you've got $1 million in a portfolio superannuation and you don't insure that? Sorry, it's not fun. All right, let's look at the 9th measurements. This is Goldman Sachs. Does anyone know what Goldman Sachs is?
Goldman.
Goldman. What does the heading say? So goes Goldman Sachs, so goes the market. Ask any hedge fund trader. All right, so that is actually a chart of Goldman Sachs because Goldman Sachs is one of the leading leading indicators they watch for a market direction. Now, interestingly enough, look at that. The 8 looks like it's going to cross over to 21 shortly, but I've been watching that chart, right? So that's another one we're going to have a look at. And then last but not least, we've got transports, which is another leading indicator that's used, right? Now, if you don't have that in your charts, on my chart, it's called Dow Jones 20, right? It's in the Dow Jones. This is Dow transports in the Dow Jones, right? Because if there's more transport, means there's more growth, right? That's why it's related. So if you don't have that chart on your charting software, you can go into stock charts and it's $ Dow Jones transport. Right? This industry is always the first to turn low in a downtrend and always the first to head up in a bear market. Okay, so watch this, and it will often do this weeks, even months in advance. So it's a good one to watch in the future if we have a big bear market and watching for where we're coming out of, okay? So that's what that's looking like at the moment. And to be honest with you, that's not, look, very interesting, tested your 200-day moving average. So to me, it's still fairly good, but it's tested it twice in the last couple of years. But it looks like it's the moving average is starting to roll over. Okay, so we watched that. It's heading back down to it's having another crack at the 200-day. moving average. And a lot of times I find, I think I discussed this at the last meeting, test it once, test it twice, test it 3 times. If it doesn't, then it'll be bullish for me. I'll be a contrarian, okay? Let's move on. So you've all got a copy of this 10-point checklist. Decide to print them out, so you can even scribble on it if you want to. How do I need to know when to act? I've already told you this. When we have 7 or more points in the checks, let's confirm your direction. This means you should start implementing strategies, and we'll talk about some strategies shortly, right? So 8 out of 10 is probably the right time to pull the trigger, even though it might seem scary at the time. Because you've got to be a contrarian here, okay? The best trades will happen when the majority of readings are in alignment. So who reviews their trades? Once a year? Anyone? No? No? No one? Every quarter?
Every hour.
Every hour? Fantastic. I'm talking about reviewing your whole portfolio and seeing what went right and what went wrong. It's very interesting because, you know, a lot of times my performance is based on 1 or 2 shares, you know, not trading them right. Usually it's a mistake. Not looking at the market that day, or laying and hanging in Thailand or something. Anyway, so I'll stress this, the best trades will happen, the majority of readings are in alignment. So if you follow this, have a look in 12 months' time and come back to me and see if that's not right. I suggest you make it part of your daily routine if you're a serious trader. Go through the checklist and make notes. If things are neutral, do not commit to big directional trades. I would not recommend buying when the checklist suggests that it's bearish. So try not to be contrarian there. And if the trend is bullish, try not to fight it. We saw that Tesla chart. Now, if you had high convictions on shorting that, you're in trouble, aren't you? Yeah, so I said like in the presence, because I just showed you all those charts. What are they showing? You can't fight that. It's painful if you do. I've already said that, really. Look, I believe you should review your trades at least once a year. And if you're not doing it now, why don't you make that part of your trading plan as part of your routine process, right? I have daily routines, weekly routines, monthly routines, quarterly routines, and annual routines. Okay, so I encourage you to do that. So the checklist will help you find those lucrative, extreme turning points in the market. You don't have to understand, I'm going to reiterate, you don't have to understand anything more. Is it bullish, bearish, or neutral? It's pretty simple, isn't it? I've simplified this. And there's no financial rewards in fighting the markets. That's just stroking your egos, ladies and gentlemen. As hard as that sounds, that's all you're doing. Your goal should be to find stocks that are moving in the sector or index. So generally I look for hot sectors. What's the 3 hottest sectors? I generally find I can just stick to 3 sectors. That gives me plenty of stocks. 2 sectors is enough. Find what the 2 hot sectors and then go and find the hottest sectors in that stock. To me it's pretty easy, right? And then I have cold sectors. We'll talk about that in a minute. It's important I have hot and cold sectors because at any point in the time I might want to balance things or hedge things. We'll talk about hedging with shares or CFDs. So hedging your portfolio. So if you're worried that the stock market might crash or that we have a significant correction, but you don't want to sell your shares. This is an excuse, particularly in Australia, I suppose, is because we've got capital gains tax, right? And it makes it a massive headache. I don't think there's too much use other than the photographer over there in this room. So most of them acquired assets for a long time, and then we're going and buying stuff a long time ago and probably appreciating you've got to pay tax on it. None of us like paying more tax than we have to. Do with stock shares, CFDs and options, right? That just keeps me busy. I haven't even had time to start cryptocurrency, but I don't have time. Anyway, so I like trading Pro Shares Short, it's called. Ticker code SH. It's on the US markets, right? Takes short positions in the market and it is inverse. Right? So it goes the opposite. If the market's going up, your exchange traded fund goes down, and vice versa. So if the market goes down, you'll make a profit. So it's inverse. Does that make sense? The next one is trader shares ultra short. What does ultra short mean? Well, it means it's leveraged. Right? So, and its ticker code, both of these are for the S&P 500, which is the biggest market. Ticker code SDS, and that's it. That includes no. This is 2 times leverage, so it'll go double the direction. This is if you want a bit of fuel in the rocket. Okay, does that make sense? So that's those two. And the other thing that you should note, in my opinion, these are not for long-term plays. They're for short terms, right? Because in bear markets, they're short and sharp. Okay, that's it. Us poor old bulls have to just keep worrying along, and it's like when the next market crash, if the market goes up, and that's the way it works. So they're US markets, but I mean I can hedge my Australian portfolio in the US. And as I said, most of the time I hedge myself with options. I just find them easier, quicker, and a lot cheaper. And I have lots of strategies that I can make. I can even get credit spreads. So they pay me to take my hedge. Right? But that comes with experience of trading options. Australian ETFs, there's the BEAR, B-E-A-R, named very appropriately, isn't it? And it's a better share exchange traded fund. Now, don't quote me to these. There might be more now. But when I looked not too long back, I've traded these, right? So, and I do trade these. So Bear's like just the single short fund, and BBOZ, which is Bear's brother, that's leveraged 2 times, right? So with all of these things, ladies and gentlemen, you always start off with the simpler one, don't you? And then if you want to trade on the Australian Stock Exchange, the US 500, this BBUS, it's currency hedged, so it's currency hedged against the US. I haven't traded that one. That just makes it too difficult for me, and I'm not interested. That's why I will trade US. That's why I mix them up, Australian and US options, because then I get my hedging anyway. Once again, please note these are not long-term plays, they are short-term. Okay. So that's what I've got today on hedging. Now I want to look at some other things, and we sent an email up today. I don't think that came up in the newsletter. No. What I sent out there was a picture. You know what this is? Does anyone know what that is? That is the Nikkei. Now, I want to put that because what does the heading say? What does a bubble look like? Right? And I wanted to discuss this today because if we looked at those US charts before, all I can do is continue going along. If you're a fundamental trader, I think a lot of evaluations, I'm not a fundamental trader. Is any fundamental traders in the room? No. Yes? A lot of prices are stretched, aren't they? Would you agree? Yes. So to me it would be a problem. As a fundamentalist, I suppose that then it impinges on your trading, doesn't it?
There's very few opportunities in the market.
Yeah, because you're using those rules and filters. Yeah. Right. So to me, and it's not, and like I'm 58 now, and I've seen this so many times before, and that's why I showed you the dot-com, that was just a bubble, right? As I said, then we had a mining boom here, they were bubbles, right? But we had great fun trading those. Tech, and really this market's building into a bubble again, okay? Because Like when I read fundamentals, I go, oh, it's overpriced and P's and it's so stretched and you better be careful out there and all this sort of stuff, right? But I just follow trends, right? And I can't allow that. So to me, as I said to you, I'm a trader, I've got to trade with the trends. So I use some of those hedging strategies to protect me along the way, right? So instead of making, last month, like one strategy in my portfolio made 12%. I mean, that's just ludicrous, like, if you annualise that, right? And it's just, to me, when I've been trading for so long, when you see these are bubbles building up when these things happen, right? And I can't seem, and all bubbles seem to end the same way, and this hasn't even started with that. My memory of all bubbles is when I start getting into a cab or Uber these days and they start talking stocks to me, then I'll know the right? When I start seeing that the daily newspaper prints on the front page that the market's up again 3 and 4% for a day, then I know we're getting close to the end. We're not even near that. That's not even getting near the front page, that information. That's not even getting out of the financials yet. And every market that when I've seen this here, 87, what do you think they were talking about? They were talking about Alan Bond and Airship and Christopher Skase, and I remember it. It's front page stuff. And guess what everyone's talking about? Oh, did you get on Airship? Did you get on this? Did you get on that? What happened with Bitcoin only? I remember that a couple of years ago. You go to the pub, everyone's talking about Bitcoin. They're all Bitcoin traders at the pub. Pissheads, I call them, but anyway, they excuse my language. But my point being is, I just don't see the end of the market, right? To be quite honest with you. And then there's a lot of other stuff. So there's the charts. Then, as we discussed last time, do you know the market to me, and I should pull you up that Fed chart, that the only thing driving the markets is the Fed. It's got to be just the Fed, because that's the only thing the market's reacted to. Reacted to when they tried to put interest rate up at the end of 2018, well, the market had a hissy fit and went down 20%, till he capitulated and put them back up again. And it was like, happy days again. 2019, not a problem. Just keep putting down interest rates, we're all happy. We're all happy. What does Trump tweet? He manipulates the Fed there. That bloke's so scared now, that power, it's a joke. So to me, I just can't see this ending. If you read Stan Weinstein, you have a look at the presidential election, there's 4 years, right? And the year of an election is have a look at history, it's basically an up year. Most of the time they're up. We're in a presidential election year. You got Trump and all the games that gets played there, right? Like the trade war disappeared overnight. Might think it's up ahead again, but I think China's crapping itself at the moment because of the effects of this virus and what it can do to their growth, right? So, I mean, they just chopped in half the tariffs by 50% last week. Market love that. But it's just interesting to watch this, and I just can't see the end of the market. And that's what I'm saying. So, as a trader, I can tell you all the reasons why I think the market should go down, but there's reasons the market can go up. So I need to look at both sides, right? We're going to take both positions. But today, so to me at the moment, there's no other game in town other than going long at the moment if I look at those charts. And then I've just got to stick, if I stick to the hottest stocks and the hottest sectors, they've got to be going up because those charts are just a reflection of those basket of stocks going up. So ladies and gentlemen, my fear is, and I mentioned this at the last traders meeting, I think the biggest threat is what we call a melter, which is the last part of the bubble. Right? Now if we look at this chart, this is just over a year left. Like, you could have made all your money in that last part of the bubble. Now, the interesting thing is, so if I overlay this on US charts, we're not even really up to, I just reckon we're up to about here somewhere. But it could do all that in 6 months. And bubbles always end at prices that we would never believe imaginable. And me saying that, just we'll talk about the Dow disease, but I mean, so I talk about the Dow 30, you get 30,000, you get, yeah, big deal. It's not far away, that could be next week. So I said 40,000. What if I said 50,000 by the end of the year? Yeah, ha ha ha. But that's exactly what a bubble does. Trust me. And that, if you miss out on that, you miss out on a massive opportunity. You know why? Because if you didn't make your money there, look where we are now, 30 years later. Just some food for thought. Okay? So, what I'm suggesting, I don't want to be putting my guns in my holsters. I don't want to miss massive gains. So I have to have strategies to protect me to be going along when I think that it could just fall apart at any point in time. Because I think it will. And it'll get to a point. We'll get to a point, that up there, the top of that is when we've run out of buyers. And then everyone heads for the doors. And then it becomes a race down the other side. And that's how that works. So I just wanted to keep things in context, and I wanted to remind you. The other thing is, if I look at, the other thing is, and I don't know if I room here, but I mean, I've got a fair amount of cash. I don't know what you're doing with your cash, right? Actually, I've got a section on that. Yeah, I'm jumping in the middle. So let's have a look at another bubble. There's Tesla. I mean, that's a bubble. That's 3 months. It's just, what, 400%, 500%. Anyway, they're just a couple of bubbles. Now, if we got to the end of the year and I saw a whole lot of charts like that, I wouldn't be surprised. If it crashes, I wouldn't be surprised. But as traders, we have to be ready for both sides. That's my point. So, sorry, I'm getting carried away. So where do I put my heart in? So interest rates are falling, or they're negative in 40 countries. Do you know if you get a mortgage in Denmark, the bank pays you to take out a mortgage? I don't know, I wasn't taught that in economics. They didn't tell you that to get rid of debt, you create more debt. It's the opposite. I must have learned too long ago, that was in the 70s. They do it differently. If I Google economists, like how do we get out of this, there's not the only answer I can find that's logical to me is what's called a reset. And we've had a couple of resets in history. That's where you take your wheelbarrow of cash to the bank and they give you a coin and say, oh, we've reset the currency. It's great, isn't it? Fantastic. So bonds are similar. The US 10-year bonds are at 1.5%. Can anyone live on 1.5%? Huh? Another thing I want to point out, I got up at 5 o'clock this morning, shows you how bored I am. There's a CNBC article there. This just, like just over a cup of tea this week. You're like, are you serious? So they were suggesting, this Jeremy Siegel, and he's supposed to be an intelligent fund bloke. Anyway, it's like, he's going that the traditional 60-40 asset allocation model is broken, 60% in equities and 40% in bonds. Well, I know why he's saying that, because it's already at a 1.5% yield. Like, who can live on that? Jeremy Siegel believes that dividends will be the new bonds. So he's suggesting he's developed 2 portfolios based entirely on exchange-traded funds. So he's suggesting everyone to tip all your money in the stock market. It's starting, ladies and gentlemen. And I woke up a few years ago as I said, I was pulling out of the property market, so I started building up cash in the bank. And it went from 3% to 2.75 to 2.5, and I was going, what's going on here? So I actually looked at it as opposed to, I realised I was asleep at the wheel. And then when I looked into all this stuff and what it all means, it just freaked me out, to be quite honest with you. And today's not about that, right? So it's when, you know what, like, this is madness what's going on. It's absolutely unprecedented. However, these people are now suggesting to put all your money in the stocks. And I know why, because the other thing is, and if you're not aware about that, an Australian economist, and there might be a few people who are really following Martin North. Does anyone follow Martin North? No? Not one. Okay. Anyway, he's great. He's unbiased. He's an Australian economist. He's on YouTube every day. I can send you one if you subscribe. And all he does is give you such interesting information, stuff that's in the Senate that they're trying to pull the wool over our eyes and all this sort of stuff, right? Because they're trying to ban cash. They don't want you to have any more than 10,000 cash would be illegal. They want to try and bring in. There was that. There was, they've changed the bailout laws to the bail-in laws. Does anyone know what the bail-in laws are? Like, all this stuff is just getting underneath, and like the people in the street don't know what's going on, right? This guy keeps me informed with that stuff, and it's very interesting. He does a lot of property stuff. He does wage growth, because he's an economist, right? Oh, he's just got, but he does all that number crunching for me, and I go, that's fantastic, right? Into the jobless rate, the underemployment, he's got all the mortgage stress, he can tell you what groups they're in. It's amazing statistical information. It's about 10, 15 minutes a day, and he just keeps you updated. I just find it interesting. And now, he makes you aware of a lot of this stuff with the negative interest rates, and you know, governments want to go into negative interest rates because we're going to be paying for the debt, not them. They realise they can't get out of it. Anyway, that's starting on that. So these things are starting to point me out. This morning. I got up at 5, that was the article about 4 hours old by then. And I just went, this is the start of this, right? That's just my opinion, of course. So powerful demographic factors such as the ageing of global population, longer life expectancy through technology, broader inclination to avoid risk, because we're all getting older, right? We don't want to take on as much risk. Right? Slower growth in overall markets, as we can see right around the world, all of them are slowing down, but even the Chinese market, right? They're suggesting for the next 3 months it's going to be 1% growth. That's going to be a big drop from their 6% down to 4% or less, right? That will affect global growth, without a doubt. Personal, corporate, the government debt, all these factors and more suggest that these level of interest rates are around for a lot longer, unfortunately. All right, so that's enough on that. So let's now have a look at markets. So here we have, so what's the time now?
20 past.
This is the S&P 500, and it was down a couple of percent on Friday night, and this is over the virus again. I just find this virus very interesting because if we go back a couple of weeks, it was about the virus, and then the next day the virus is okay, and then it's virus again, and then the next day it's okay. And I'm just going, it's a bit of a neurotic market at the moment, in all honesty. But apparently this morning it came through there that there's more deaths from the SARS, more deaths on this virus than the SARS virus. So this may get a bit of momentum. However, as discussed in the December meeting, that I think the best thing for the market in terms of, to me, this from October, all this there, that's already a melter. Look at the pullback, look at December, our little pullback. The meeting I think was there, around there somewhere. But anyway, that is little pullback, it's nothing. To me, this is just a melt up at the moment. So the healthiest thing would be to get a nice big pullback or correction. 10% would be fantastic. And my belief is that it'll just keep carrying on because you look at those charts, they're not changing in a hurry. However, if we follow the strategy that I've showed you today, you'll keep an eye on this, okay? Because those charts can fold over fairly quickly, not monthly so much, but the daily will.